With gold's descent from all-time highs from a few months ago, some investors in the gold community have lost hope in the yellow metal. Let's break it down with Kitco News' own senior market analyst, Jim Wyckoff. Jim, it's been so long since we've had you on the live program on video, but I know you write for Kitco every day, so fans of your work are missing your written work, but we haven't seen you on video in a long time. Welcome back.
Well, good to be with you, David.
Good to be with you too, Jim. I only have one question to start off the interview for you, and that is, can we ever see $2,000 gold again?
Oh, absolutely. That's not a bold prediction by me. That's a simple study of longer-term price charts and commodity price history going back over 100 years. Commodities are highly cyclical, including gold. They go through times of boom and bust. We're in kind of a short-term bust cycle here for the gold market, but indeed, I look for gold prices to rebound here at some point in the not too distant future, and in the coming years, and maybe sooner, we will indeed push back above $200 or $2,000 and hit new record highs.
Yeah, I was speaking with an analyst yesterday, and we had an interesting discussion about possible scenarios for gold. And he was asking me questions, and he asked me, what would it take for gold to hit $5,000? And I said to him, really depends on your time frame, right? If you're talking about $5,000 gold in a few years' time, I'd say nothing really needs to change in our environment. If you're talking about 5,000 gold next year, I think some major catastrophe needs to happen. How would you break it down? If I were to ask you a philosophical question about $5,000 gold, how would you respond to that?
Well, for $5,000 gold to be hit, I think you'd have to see some seriously problematic price inflation. We're not seeing that yet, but some would say, including me, that the table is set for some significantly higher inflation in the coming months and few years, and that could indeed spark some increasing demand and price appreciation for gold and other metals. Also, if indeed the Bitcoin bubble bursts, and I'm not saying it's going to, but if it does, and you see that asset start to go south, then you could also see a wider demand scenario for gold.
Okay. Now, Jim, I know your expertise is technical analysis, so we're going to start with a longer term time frame and then narrow it down to more recent price action. So we spoke actually last summer, you and I, on video, and at the time I remember sentiment was almost euphoric. Everyone was talking about gold. Mainstream media was covering gold. The tune has changed somewhat. Can you describe in a few sentences the main causes for gold's descent from August highs all the way to current levels?
Well, there's a couple of things, a couple major things. One is risk assets are in favor right now. Stocks, just today, the U.S. stock indexes, the Dow and the S&P hit new record highs. That's a negative for the safe haven metals. Bond yields are on the rise, nowhere near what they were 10 or 15 years ago, but nonetheless, bond yields are rising. That's paying a better dividend to holders of government bonds, and that's, gold has no dividend, and that's kind of putting some pressure on the market also. And just recently, you've seen an appreciation in the U.S. dollar index. It's backed off a little bit this week, but that's also a negative for the metals. So those things are working against gold on a near-term basis. But if you look at longer-term charts, like a monthly chart especially, and even a weekly chart, I would argue that those longer-term charts are still favoring the bullish camp in the gold market.
Can you explain what that means? Why would they be full?
Sure.
How long is this chart that you're referring to?
Monthly chart dating back, say, 50 years, okay, really tends to show the historic highs and lows in the gold market. And if you look at a monthly chart, you can argue that prices are still trending higher on a longer term basis, numbered in years. Yeah. And it can be argued that this pullback we've seen recently is just a normal downside correction in a longer term price uptrend.
Mm-hmm. If you look at the last two bull cycles for gold that lasted around 9 to 10 years, so the first one being 1981, we had a peak in gold, and then the second one being 2011, we had a peak in gold. Both of these peaks were followed by subsequent declines in the gold price that lasted for months, and then years of just low volatility price activity in a lower bound. So basically, every time it's hit a high, it's come down, and then it takes 10 years to reach a high again. Is this time any different?
Well, it may or may not be. We don't know yet. Again, this downside price action we've seen in the gold market recently on a longer term basis by looking at the monthly chart is so far just a downside correction. It's not even a downtrend on the longer term monthly chart. So it may be. I mean, nobody knows if gold prices continue to lose significant amounts of value over the coming months. We could indeed be embarking upon a longer-term bear market, but right now that's not the case.
Okay, all right. So you've made your case for the bull market, but entertain us for a while. Suppose we were to see a bear market, the exact scenario that you just described, Jim. What needs to happen in the macroeconomic landscape? What other variables need to move in order for gold to move down even lower?
Well, I think on a near-term basis, we are trending lower on the daily charts. It's important to understand that gold can trend in different directions in different time frames. On a near-term time frame, based upon looking at the daily charts, gold is trending lower. In fact, it's in a solid price downtrend on the daily charts. So that means we're probably going to see a little bit more downside price action in the coming days, or maybe even a little bit longer. Rising bond yields, a continued rally in the stock market, the stronger dollar, the continued appreciation in Bitcoin, those are all negative elements that may continue to work against the gold market here in the near term.
Now, you wrote something very interesting in your report today, this afternoon, Jim. You said losses in the precious metals are being limited by a weaker U.S. dollar index and higher crude oil prices. What's the relationship between crude oil and gold? I've never heard that before.
Well, crude oil is arguably the leader of the raw commodity sector. If you look back at crude oil's major run about 10 years ago, you'll find that many raw commodities also had major bull runs, including the grains and the metals. So crude, in my mind and in many analysts' mind, is the leader of the raw commodity sector. And if crude oil prices continue to trend higher, that is going to be a bullish element that's going to work in favor of other raw commodity prices trending higher too. It also, higher crude oil prices leads to higher inflation. And inflation on a longer term basis is bullish for the metals, as history shows.
You have written in your report on inflation, you said, still inflation readings from the major economies are so far not running hot. Which are these readings you're looking at, Jim?
Well, readings coming out of the European Union Consumer Price Index, the U.S. Consumer Price Index, the Producer Price Index, even China. China's running a little bit warmer, I should say, versus the U.S. and the European Union, but still not problematic. However, the monetary policies of the central banks over the past year, very stimulative. The spigots are open, some would argue wide open on money flow. So that we don't know what the longer term implications of that easy money is going to be, including the just signed 1.9 trillion stimulus package for the U.S. My bias is that in the coming months, you're going to see some higher price inflation, maybe even problematic price inflation that would work in favor of hard assets over paper assets like stocks.
Does gold follow mostly the American CPI or the inflation indices from other countries as well? Suppose we have economies moving in divergence from each other. You have an economy that's recovering, let's say in the US, but not so much in Europe. You're going to have a divergence in inflation readings. What happens to gold then?
Well, that's a good question, but you usually don't see that. In fact, I can't remember the last time. Maybe China's economy was running hot pre-pandemic, but the rest of the collective world economy was mitigating that. So if you had divergence, the U.S. and China, the world's two largest economies, they're obviously going to hold more weight than even the European Union or Japan.
Okay, fair enough, Jim. And before your closing thoughts, let's talk about bond yields real quick. You have written about bond yields in your report. You said that bond yields have stabilized somewhat this week, but still trending higher. what's your take on how high bond yields could go before the Federal Reserve needs to intervene? Could they or should they?
Well, David, historically, bond yields are still pretty low. When I got into this business 30 years ago, the yield on the 30-year bond was upwards of 8-9%. So, historically speaking, we still have pretty low yields. And it's, I think you're going to have to see bond 30-year. I'm talking 30-year now. Well, let's talk 10-year. The 10-year is the benchmark. I think you're going to have to see 10-year bond yield or 10-year note yields upwards of 3% to really spark some fear among Fed officials that they might have to do something. But again, the marketplace really wants to do what it wants to do, and the Fed is going to be keen probably not to intervene if they don't have to.
I know gold has a direct inverse relationship between real interest rates. So suppose bond yields rise to 3% from current levels. That's actually quite a significant increase from current levels. So if that were the case, what would inflation need to do in order to keep up with the rise in bond yields? And can we see perhaps even a rising real interest rate environment, which would be bad for gold?
Well, absolutely, David. I mean, if bond yields or note yields reach 10%, then you're going to see inflation in lockstep, because the 10-year Treasury note is a reflection of price inflation to a degree. So if you see yields on the rise, you're going to see inflation on the rise also.
Okay, Jim, summing it all up now for us, your short-term sentiment on gold based on daily charts, based on what you've told me, how do you think we should be positioned?
Well, the path of least resistance right now on a short-term basis is sideways to lower, and it's going to continue that way until we see some kind of a chart signal to suggest that near-term price downtrend has been broken. And for those that want to know when that's going to happen, keep reading my AM and PM reports, because it will be there that you'll find out those early clues.
Fantastic. Thank you very much, Jim. And when that does happen, I'll have you on again to talk about the inflection point. Thank you for coming on.
Thank you. Bye-bye.
And thank you for watching Kitco News. If you're watching this on YouTube, don't forget to subscribe. I'm David Lin.